Please like, comment, or hit the bell icon to subscribe. Hey, Scott Rulon here, and we are going to talk mutual funds. What are they, and what do they do? So, what on earth is a mutual fund? Welcome to What on Earth is a Mutual Fund. A mutual fund is a pooled group of investments like stocks, bonds, debt, and even managed futures. The large mutual fund companies are names that everybody knows, like Vanguard and Fidelity. According to the website Statista, the mutual funds are in the range of 7,636 funds at the end of 2020. There are more mutual funds than there are stocks on the U.S. stock exchanges. In fact, worldwide, there are somewhere in the neighborhood of 9,000 individual publicly traded stocks. Although frequently argued by a couple of fund companies, Massachusetts Investors Trust and State Street make claims to creating the first open-end mutual funds. Open-end mutual fund companies are said to be making a continuous offering at a price called NAV, or net asset value. Net asset value is derived by taking total asset value by the total number of shares. Mutual fund asset allocation. Mutual funds pool a large number of stocks or bonds together and offer each investor in the pool a percentage slice or tranche of the pool. Sometimes I like to describe one in the following way. Let's pretend we are baking a cake. We would need at least some of these ingredients: flour, sugar, baking powder, eggs, flavoring, and perhaps some baking soda. These ingredients are all mixed together to form a cake. Once baked, you cannot tell where the eggs end and the flour and sugar begin. What you do know is that you own a small slice of it. As the total cake grows, so does the value of your slice. Why is asset allocation important? Well, I like to use the following analogy. Let's pretend like we are going up in an elevator in a tall building like the Transamerica building in San Francisco. One elevator has one cable and the other has 6. In the case of an earthquake, which elevator would you rather be in? Obviously the one with 6 cables, because the one with a single cable would take you for the ride of your life if the building shakes. For example, thinking of it another way, you would not want all your eggs in one basket, especially if the basket drops. Well, you get the picture. 2 types of mutual funds. There are closed-end funds and open-end funds. The closed-end funds usually buy a basket of investment product with little to no change in the mix. So basically, there are a fixed number of stocks or bonds and a fixed number of shares. It can trade at a discount to value. The open-end fund is said to have a continuous offering. It continually offers shares. It will have a specific investment objective, like large capitalization or small capitalization components. You would always want to make sure it does not have style drift. In other words, it does not buy investments other than its objective. You bought it for a reason. It should not drift from that. Asset allocation overlap. When several mutual funds contain the same specific investment products, they are said to have overlap. That is why you would not want to own several large cap value or small cap value funds at the same time. If they share a large percentage of the same stocks and those stocks go down, you could see a loss in value of all your mutual funds. So be careful. By the way, if you are looking for ways to make money to invest in mutual funds, try this free ebook, The Millionaire Shortcut. My blog is located at myfinancialfair.com, so here are a couple other materials and blog titles I've written. Secret Ways of Online Marketing Revealed. Polygon, Legit or Not. how to visualize future success, how to create a budget, and lastly, please do not forget to like, comment, and subscribe by hitting the bell icon.